Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Chris Watling from Longview Economics. He's the global economist and chief market strategist, and he's going to be talking to us about everything that is going on in the world right now. Chris, thanks for sitting down with Livewire. It's good to have you here again.
Great to be back. Appreciate it. Looking forward to chatting.
Indeed. Let's start with the big picture first. I've been speaking to some people lately, and a lot of the conversation is around the cross currents. A lot of cross currents going on at the moment. So easy question to start with. Where are we in this cycle? Where the hell are we and what's going on?
Yeah, what a great question. Where the hell are we? I mean, and of course what's happened is the world's been completely distorted by the pandemic. We're still living with that. Yep. We kind of forget that. So huge inflationary surge in 21, 22, huge rate hikes, in 22. And really a lot of the Western economies have been on stall speed for 2 or 3 years. That is what I think is so interesting. It's characterized by what you see with the industrial cycle. If you look at industrial production in the US, it's flat since 2022. Highly unusual. Look at ISM manufacturing below 50 for 3 years. It just doesn't do that. Very abnormal. But here's the good news. Inflation, I think, is basically dead. Okay. Now, I know if you talk to the RBA, they wouldn't sign up to that.
Yep.
And, if you talk to the Bank of England, they might be a bit hesitant and the Fed a bit hesitant. But the reality is inflation looks a little bit too perky at the moment because of tariffs. This is going to roll off and we're going to get into next year and we're going to say inflation's gone and we're going to get even more rate cuts. And actually, if you think about it, in the old days, you'd talk about inflation, you say, what's the oil price doing? Well, it's down 20% this year. It was down 2% last night. What's rent doing? Well, in the US, it's running at 10-year lows. It's going to go lower next year in terms of growth rate. House prices, nothing, et cetera, wages. So there's no real inflation impulse in the US and indeed in much of the West. And as a result, we're going to get more rate cuts. We've had a ton of rate cuts this year, and that is going to deliver a global cyclical recovery, to your point. Right. So cyclical upswing, mid-cycle slowdowns where we're at. Next year is global cyclical recovery.
Yeah, that's a pretty bullish outlook. So good positive note to start on. Talk to me a little bit about, and you touched on it there, money getting cheaper again and how that feeds into the equation. How powerful is it? What does liquidity look like, especially over the next 12 to 24 months?
Yeah, a critical part of, equity markets, in the sort of uber long term, they're all about earnings. And it's all about what Warren Buffett called a bird in the hand is worth two in the bush, quoting I think it was Aristotle who said it, sort of 600 BC or something. Yep. And it's well worth listening to that video of Warren Buffett. It's a terrific explanation of what drives stock markets. If you look over 100 years, it's all about earnings. It's not even about the PE ratio, because that mean reverts. But in the short term, to your point, it's all about liquidity. Liquidity. Rate cuts and liquidity is the guts of the whole story. And look, we've just had a central bank in the US that's stopping QT. And actually, we've also had Fed's John Williams from New York and Laurie Logan tell us that actually we think we should start buying assets again, So, and now they've said, it's not QE, of course it's not officially
QE by another name, yeah.
Yeah, but the bottom line is they're buying assets, they're creating new money, that's liquidity. And I think they're going to kickstart that at the same time we're getting all these rate cuts out of the Fed. So liquidity looks great next year, and that's a massive piece of the whole puzzle.
I just want to touch on there, the US debt and this whole idea of running it hot and inflating away the debt. Thoughts on that?
Well, in the long term, you've got to do that, haven't you? Yeah. You're not going to default. You're not going to push austerity on your... Certainly Trump isn't. He's the last thing from his mind. Yeah. So you're probably going to end up with more inflation than you'd like. And in fact, in one small way, I think what the New York Fed's Williams said the other day is kind of speaks to that. They just, as soon as they see a little bit of flare up in the repo market with the SOFR rates and the spreads widening, and they're starting to claim that reserves are too tight and they need to print more money. So in other words, they've got no backbone for shrinking the balance sheet back to where it was pre-GFC.
There's no political will for that.
There's no political will. There's no central bank theoretical backbone. Yeah. So I think ultimately you'll end up, inflation will do a lot of the heavy lifting.
Good for equities then, it would seem like. That's sort of the base case. There's a bit more to go in the rally, it seems.
Yeah, liquidity is king and rate cuts are king, and and we'll get onto the AI bubble, but I think this global cyclical recovery, earnings growth, this is a terrific backdrop for equity markets, and we're seeing them break out to the upside. There's some strong markets out there.
Yep. Just on that, just zooming in a little bit more closely, I was at a breakfast this morning and there was someone providing a sort of 10-year view and suggesting that emerging markets and even Australia might outperform the US over that period, just because the valuations in the US, as you would know, have really marched ahead. Do you have a preference right now or over the next couple of years in terms of regional equity markets or geographically?
Yeah, we do. And I think there's this theme of sort of broadening in global equity markets, broadening beyond US large cap, which has been so dominant for so many years. I think that's definitely happening. We like some of the EM. We like quite a bit of Europe. We've been playing Spain a lot this last year or year and a half. Spanish market's up 72% this year. Right. It was up a ton last year. It's kind of got all the ingredients, Spain. It's structurally really strong. It's running a current account surplus. Fiscal balance is good. Cyclically, it's doing well. It's one of the fastest growing economies in the G20. And it loves cheap ECB interest rates. It loves cheap money. I always like to joke, if you want to understand Spain, just go to one of the bars in Spain and buy a glass of wine. And the price of the glass of wine tells you everything about the Spanish economy. Right. Because, I've been asking everyone in Australia, I think a glass of wine in Aussie would be, 15?
And a bit, yeah, a bit more.
A bit more.
Yep,
in
definitely.
London, if you buy a glass of wine, it would cost you in a pub £10 at least, probably 12, depends on the quality of the wine. Yeah. In Spain, if you buy a glass of wine in a bar, it's €2.
Wow.
And that is a wow. That is a wow. And it's only €2 because the whole labour market, the whole economy is cheap. So it's had an internal devaluation, what we technically call an internal devaluation. The unit labour costs and the labour costs have come down dramatically in the last 15 years. So Spain's cheap to make stuff, labour's cheap, the economy's structurally strong, cyclically it's responding to interest rates. And of course it's a cheap stock market with earnings growth, and earnings growth faster than the US. So to your point, what are we buying? I think there's this broadening globally, and there's some really good country picks out there. I like Chile. I mean, Chile's a bit obscure, but it's a copper play. I mean, they revised up their own copper forecast today, and of course, I think it's 15% of the world's copper production. If copper does well, Chile does well. I think copper will do well next year in a global cyclical recovery.
Spain, 72%. It makes the 20% on the S&P for the last couple of years look pretty inconsequential. Exactly right. Let's shift gears. You mentioned AI and AI mania. We've just seen NVIDIA results this morning. They managed to beat quite handsomely. Is that a bubble? What are you doing about it? Are you worried? Do you just ride the train?
Well, some trains you just don't want to get off. Yeah. You've got to be careful when you get off them. Look, it's clearly a bubble. I think it ticks all the boxes. Yep. Bubbles about cheap money. Bubbles have a load of debt associated with them. We got speculative debt coming out of our ears in this bubble. But we haven't really got that much CapEx funded debt, or debt funded CapEx even, excuse me. So that's just beginning, I think, with Oracle and these in the last, and Meta and Blue Owl, all these guys starting to fund stuff with debt. So we haven't got all that. We have got an expensive stock market. We have got expensive stocks, and we have got a great story. That's kind of the Kindleberger framework for what is a bubble. If you look over history, that's what defines it. But Kindleberger says that bubbles end when money gets expensive.
It's not expensive yet, is it?
It's not getting expensive. It's getting cheaper. Yeah. So I think you've got to stay on the train. Don't try and be too clever, though. We are basically neutral US large cap. So we're not trying to go underweight, but we're not overweight because, these things are dangerous to play in. I think I know when I can judge the end, but I don't want to be overly confident.
That's hard to do, isn't it?
Yeah.
You touched on Spain and Chile. Germany. Let's go to Europe. Looks like it's turning a corner. How important is it for the whole European Union? And again, how is it shaping out in your portfolio?
Yeah, I mean, Germany's really important. Of course, it's the biggest economy in the Eurozone, meaningfully. France is a bit of the sick child of Europe at the moment. Yep. So Germany's got to do its bit. But they are doing their bit. I mean, the big fiscal stimulus coming through, 0.9% of GDP. They've got a lot of rate cuts in Europe. So. And all this defence spending that's happening. So there's quite a lot of positives in Europe. Also, you've got deregulation coming to Europe. This is like a new thing. We've been 15 years of regulating risk, and now you're starting to deregulate. Look, I mean, it's amazing to me. People actually want to talk about Europe, which hasn't
Been a
happened for a
basket case
long
for a
time.
while, yeah.
But the world's, it's cyclical. Yeah. It's like you said about that guy at breakfast. You know, over next 10 years, you probably don't want to own US equities. Yeah. You probably want to own some European stuff.
Yeah. So you're overs Europe in the portfolio at the moment, or the allocation? Yeah.
We're overweight Europe, absolutely. We're overweight some of it thematically, like Spain, and some of it large cap as well.
Yeah, right.
Just in general.
Okay. Let's change regions again. China. Sugar rush now, perhaps a slowdown later. Is that still your base case? And again, what are you doing about it? Yeah.
Yeah, China. It's disappointing, isn't it? And the last data is going the wrong way. I mean, again, you're coming back to your 10-year thing. China's in a 10-year unwind of excess, and it could be 15 years. Who knows? So they're battling that, and that's our sugar rush thesis, that you have an odd year off from battling it, and if you put enough stimulus, occasionally you get a bit of a bounce. We've been overweight China. We're kind of pulling that back now. It's been a good year.
I was going to say the equity market's run really quite hard off the lows, hasn't it? Yeah.
It's been great, and it's also been a cheap AI play.
Right.
Which Alibaba and all
Tencent,
these guys. Yeah. So that's kind of great, but you know, we've always been the view with China. It's a trade, not an investment. Don't fall in love with it. Right. Structurally, it's got huge problems. It's been a great year. We're still a little bit overweight, but I wouldn't be too aggressive on that market.
Let's bring it home. Australia. Where do we fit in all this?
Yeah.
How are we going? Tell us some good news, Chris.
Well, your currency's cheap.
Yeah, right.
Your
well, that's
currency's
a good thing.
cheap. Yeah. You might win the Ashes.
Maybe.
Hopefully not. Probably will. But yeah, I mean, I think we like Australia because, I mean, it really is the lucky country. I've given up trying to forecast Australia. Yeah. It defies all predictions. And of course, now you've got a few rate cuts, your housing market's a little bit perkier. And there's so many good commodities here. It's quite extraordinary. Nat gas, you know, you fell on your feet again with the Nat gas trade.
Although we're trying our hardest to ruin that too, sending it all to Japan and not having enough for home.
Right.
Yeah.
I mean, there's a ton of structural issues in Australia, as you guys know and your viewers know extremely well. But compared to Britain, where there's a ton of structural issues, I think you seem to come through it better. Yeah. So I'd be optimistic. I like the currency. And actually, back to the cost of beer. I thought, coming to Australia, traveling around the world, 10 years ago, Australia seemed really expensive in a global context.
Right, okay.
Now it doesn't. Mainly because everyone else is caught up, and you guys haven't moved that much. I mean, Spain's obviously gone the other way, but the UK's as expected. New York is nuts.
Yeah.
You know, lots of Northern Europe can be quite expensive. So I think it's changed in that, and that's a positive. For Australia.
Well, context matters because I reckon you asked the average punter here about the price of beer and they're scream blue murder, but compared to the rest of the world, it's probably not so bad.
Not so bad.
Most important thing for investors to remember as we head into 2026. No crystal ball stuff, but just what's top of mind for you as we roll into next year?
I think top of mind is what happens with this inflation data, and how soft is the US economy under the surface. And top of mind as well, I think, is, you know, Trump has a plan. It doesn't seem like it at times, but he does have a plan. And the plan is to stoke this economy into the midterms. And I think that's what he's going to achieve. Juice it. Yeah. He wants to get votes. I mean, the Georgia elections weren't good for him, so he needs to respond to that. So I think everything he does will be about the midterms.
Just a microcosm of that, to see him reduce or remove tariffs on beef and a few of the other things, to address cost of living, and that is vote buying, for lack of a better description.
All about vote buying, absolutely. And I learnt a lot about US politics with these Georgia elections, and they vote people onto public utility boards, which I didn't know, new to me. And it was all about the electricity price, that election. And it went from Republican, who'd been on the board since 2011, to Democrat.
Right.
And it was a massive swing. And that's exactly what Trump's reacting to. Yeah. Cost of electricity. And that's an interesting angle as well. Cost of electricity in this context of AI.
Which is gobbling up all the juice, yeah.
Which is gobbling the juice. And actually, that, again, China's got the cheap electricity.
They do, yep.
They're at solar tipping point.
Yeah, they've got that side of the equation, and they're way ahead, apparently, of the US in terms of energy production, yeah.
Way ahead. And their grids are amazing.
Yep.
Of course, everywhere in the West, our grids are terrible. And we're struggling to reform. In China, they are miles ahead of us on grids, on battery storage. They've got a solar farm as big as Britain's entire output. I mean, really. So I think China, this is the danger for the US, that China's going to win this race because of the cheap energy and because of the politics of energy in the States. So it really is getting fascinating.
Yeah, indeed. Chris, I could talk markets and economics with you all day, but we probably need to end there. Thank you so much for sharing your insights. Always a pleasure.
Thank you. Great to see you. Really appreciate it.
If you enjoyed that interview, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.